China's stock market surged by over 8.5% today. It made its biggest gains since the recovery of the 2008 financial crisis, and it did this from one of the largest stimulus and bailout packages in history. Now, because the stock market's up, that means that everything is rainbows and daisies, right? Well, what's that? Oh, it's not. It's literally the exact opposite. It is literally the exact opposite of that. But anyways, why did this happen? And does this mean that something very, very bad is coming to the Western world and the Western economies? Well, the answer is, well, let's see. So the backstory here begins with China's economy slowing down sharply over the past few years. GDP growth is now hovering at around 5%, which is a far cry from the 10% growth rates that China was cranking out during the heyday in the 2000s and the early 2010s. Now this 5% target might sound okay on the surface, but for a country like China, with its huge population and rising middle class, it's a red flag for its policymakers. The big issue? The property market. Real estate is huge in China. It accounts for 30% of its entire GDP. And we all know that basing your entire economy off of a real estate sector is great in the long term. Just ask how well us here in Canada are prospering with that same mentality. Spoilers, it is not very good. It is horrible. Get me out. Get me out. But over the last couple of years, some of the country's largest developers, like Evergrande, have been defaulting on their massive debt obligations, creating a domino effect across the economy. Home sales have dropped, construction has slowed, and local governments, which rely on land sales for revenue, are struggling to raise funds. China's housing sales plummeted by 15% in the first half of 2024 alone, while developers' liabilities swelled to $5 trillion with a T. What's more is that consumer demand has been weak. The average Chinese household is still wary of spending after years of economic uncertainty. Retail sales grew by just 3.1% in August of 2024, and overall domestic consumption has been slower than expected. It's like the Chinese government is trying to throw a party and everyone says, yeah, we'll be there, but then only one person shows up and his name is Jim and nobody really likes Jim that much. Anyways, exports have been struggling as well. Chinese exports have been consistently missing their targets as badly as stormtroopers in Star Wars movies, to be honest. They've missed their targets for almost all of 2024, reflecting weak global demand due to ongoing trade tensions with the US and Europe, as well as the broader slowdown in global economic growth. This has led to a steep drop in factory activity with the Manufacturing Purchasing Managers Index, or the PMI. If you don't know, if it's below the 50-point mark, that separates expansion from contraction, so China's in the contraction phase. So, to address these multiple fires burning at once, the Chinese government, under the leadership of the People's Bank of China, which is the PBOC, rolled out a stimulus package with a few goals in mind. The first goal, to finally convince cats to stop knocking things off shelves, because if they can fix that, they can surely fix the economy. Number 2 is to stabilize the property market. Policies include cutting mortgage rates for existing loans and easing home buying restrictions in major cities like Guangzhou, Shanghai, and Shenzhen. Number 3 is to inject liquidity into financial markets. The PBOC rolled out new tools to give brokers, insurers, and funds easier access to capital to buy up stocks. This is meant to stop the bleeding in the Chinese equity markets, which have been languishing to multi-year lows. Number 4 is to boost investor confidence. The government is trying to reignite enthusiasm in the markets once again, with an eye on the country's 5% growth target. Because as we all know, all economies must grow forever, and all stocks must only go up forever. This is what all governments around the world seem to want, and it's probably going to be disastrous for us all, but now, the fact that China has to roll out such a big package in 2024 means that the country is facing serious long-term problems. Let's start with the property sector once again. China has been relying on real estate to drive its economic engine for decades, as already mentioned. Hence the $5 trillion in developers with debt, as mentioned before. But really, they are kind of playing a $5 trillion game of like drunk Jenga, and I know. That sounds fun, but really, it's only fun until Connor from the marketing department is 5 shots in and pulls out one of the base blocks at the very bottom, and then the whole tower just comes crumbling down. But also, the stimulus package shows that China's old growth model isn't really working anymore. Gone are the days when massive infrastructure projects and booming exports could guarantee sky-high growth rates. China's manufacturing powerhouse status is being challenged by countries like Vietnam and India, which are attracting more of the low-cost manufacturing that used to flow to China. For example, Vietnam's exports have grown by 14.2% in 2024 alone, while China's is shrinking. If only some YouTube genius had predicted this 4 years ago in multiple videos and made some bets on this. Huh. Weird, there's no one like that out there. Now, in the short term, we're likely going to see some positive results from the stimulus. For one, the stock market, which has rallied, as we saw today. The CSI 300 index, which tracks the largest companies in Shanghai and Shenzhen, jumped by over 25% in September of 2024, marking its best month since 2014. And it did this on the confidence that a stimulus package was going to come, and when it did, the stock market jumped, 8.5% in one day. The Shanghai Composite Index saw a 21% boost in the last week and a half, while Hong Kong's Hang Seng Index surged by 23.5%. It's like that the last few weeks in China, it's been kind of like a Christmas for anyone that's been involved in the markets. But there's a catch. This boost to the economy will probably only be temporary. The fundamentals of the economy, weak consumer demand, the shaky property sector, and mounting debt haven't gone away. It's like putting a fresh coat of paint on a car that's got engine troubles. It looks good, but the problem is still under the hood and isn't really solved. Longer term, things get a little bit trickier. While the 2024 stimulus might buy China some time, the country's structural issues are going to require much deeper reforms. For one, China's debt levels are skyrocketing. The country's total debt to GDP ratio is now over 280%, which includes everything from household to corporate and government debt. This is much higher than other major economies, and it poses a significant risk down the line. There's also the aging population issue. China's population is shrinking for the first time in decades, and this demographic shift is going to weigh heavily on future growth. By 2050, 1 in 3 Chinese citizens will be over the age of 60, which will put immense pressure on social services and healthcare. Combine this with a shrinking workforce, and it becomes clear that China's growth is going to slow even further unless major policy changes are made. Now, China's global competitiveness is also slipping. Its old growth model, which relied on its cheap labor and exports, is being challenged by other rising economies. If China doesn't pivot to a more innovation-driven, consumer-led growth model, it could find itself losing ground to competitors like India, which is projected to overtake China as the most populous country and is making big strides in manufacturing and tech. So what does this all mean for us, and people in the United States and the Western economies? Well, for years, China was the world's factory. It churned out cheap goods at lightning speed, fueling global supply chains and lifting millions out of poverty. At the same time, it became the second largest economy in the world, closely trailing the US. There were serious predictions that China would overtake the US as the world's largest economy by 2030. But as we're seeing now, with the new stimulus package and economic slowdown, that timeline might be pushed further out, or it might not even happen at all. Here's where things get interesting. China's economic weakness might seem like a boon for the US at first glance, but it's not really that simple. The US and China are deeply interconnected. Despite all the trade wars and decoupling rhetoric, American companies and consumers still rely on Chinese goods and materials. When China's economy slows, global demand for commodities, tech products, and even luxury goods slow down too. That has a knock-on effect across the globe, including the United States. American tech giants like Apple and Tesla depend heavily on China, both for manufacturing and sales. In fact, China accounts for around 18% of Apple's revenue, and if the Chinese consumers tighten their wallets, US companies with big exposure to China are going to feel the pinch. Tesla, for example, sells more than 40% of its cars in China, so weaker demand could hit the company's profits very hard. And trust me, American trillion-dollar companies really need their extra profits. I mean, how can a poor company like Apple survive with a puny $200 billion in the Irish bank accounts? Now, on the flip side, with China slowing down, the US inflation could benefit. Remember, China's manufacturing is still a massive part of the global supply chain. If China's output drops due to economic weakness, it could lead to a supply chain disruption, driving up prices. However, China's slowing demand for commodities like oil and metals could lead to lower prices globally, easing some inflationary pressures in the United States. In fact, oil prices could stabilize or drop slightly, which would benefit American consumers at the gas pump, unless you're in Canada, who is going to get a hike in the carbon tax once again while this happens. So you won't really see any price drops in Canada. So you can thank Imperator Trudeau for that one. Then there's the investment side. The US investors have a lot of money tied up in China. In 2023 alone, $1.15 trillion worth of American investments were tied to Chinese companies. If China's economy doesn't stabilize, these investments could turn sour, leading to losses for US investors and funds. Additionally, with the US stock market riding high, any shockwaves from China's slowdown might dampen American investor sentiment, especially for companies that heavily are involved in China. Now we can zoom out a little bit more. China is the second largest economy, so when it sneezes, the world catches a cold, especially in countries that are closely tied to its fortunes. Europe is one region that stands to be affected by this big time. Germany, in particular, has deep economic ties to China. In 2022, China was Germany's largest trading partner, with exports to China amounting over 106 billion euro. A Chinese slowdown means less demand for German machinery, automobiles, and chemicals, which could further strain Europe's already fragile economy. Combine that with Europe's ongoing energy woes and economic troubles, the sentiment could face a double hit. For emerging markets, especially in Asia, China's slowdown is a very mixed bag. On one hand, countries like Vietnam, India, and Indonesia could benefit as companies shift their manufacturing out of China to these lower-cost hubs. This has already happened, as companies like Apple have moved some of their iPhone production to India. But on the other hand, many of these emerging markets rely on China as a major buyer of their raw materials, like iron ore from Australia or soybeans from Brazil. If Chinese demand falters, it could send shockwaves through the commodity markets globally. Now, for years, economists believed it was only a matter of time before China surpassed the US as the world's largest economy, as we already mentioned before. And by 2060, people in Alabama would soon be speaking Mandarin. But back in the early 2010s, China was on a tear, growing at a 10% growth rate per year, as we also already mentioned, while the US was recovering from the 2008 financial crisis and was growing at a much slower pace. But let's look at the numbers now. In 2023, the US GDP stood at around $25 trillion, while China's was at about $17.7 trillion. China's growth, while still positive, has slowed to around 5%, and it might not get any better given the country's property crisis, aging population, and high levels of debt, as mentioned. But here's one other critical factor as to why China may not overtake the US in terms of the largest economy in the world, and that is China's working age population could shrink by 100 million people in the next 10 years. Fewer workers mean less output, and that's bad news for an economy trying to maintain its growth. The US, by comparison, has a younger and growing population, which gives it an edge over China in the long term. And if China can't overtake the US, the global economic order will remain stable for now. The US dollar will likely remain the world's reserve currency, and American influence over global financial markets will remain dominant. China has tried to position the yuan as a competitor to the dollar, but with a slower economy, it's unlikely that the yuan will dethrone the greenback anytime soon. China's struggles also mean that global growth might slow. China has been a major engine of the entire global growth for decades. If that engine stalls, we could see slower growth globally, especially in emerging markets that rely on China's demand for commodities and goods. And if China ultimately collapses in the next year or two, the entire world economy could as well, in a similar way that the United States collapse in 2008 somewhat triggered the financial crisis all around the world. All in all, this Chinese stimulus package signals that the economic world order may not change for quite some time. And it also might be signaling that the global economy might be a lot weaker than people think right now. This stimulus could be a good idea, or maybe it's a signal that all the markets all around the world should be wary that something very, very bad could be on the horizon. Thanks for watching.